And about once a month, I'll make a video for the public, um, and I'm going to do that today. And I'm going to look um, mostly at the stock market because I think maybe some warning flags are popping up. So let me start off with the industrials. I'm going to relate this to Dow theory because we've got a we actually have a Dow theory sell signal. All right, so the Dow made a high here in whatever this was, December of last year. And then we got an intermediate degree correction. This is a secondary low, a rally, and then a rally that did not make a higher high. And then we got that move down into the the tariff scare. And it made a lower low. And now let me go to the transports. All right. These are the transports, and they confirmed the Dow back in December of last year by making a higher high. And then the transports also dropped into that secondary correction. Then we got a rally. The transports also were not able to make a higher high, and then they came down and made a lower low. And so both indexes, both averages, the industrials and the transports, broke below a secondary low, and that constitutes a Dow theory sell signal. And then both indexes have rallied out of that bottom, but the transports are seriously diverging from the industrials, which have made, they haven't made a higher high, but they're kind of double topping. But the transports are diverging significantly, and there's other sectors that are also diverging, important sectors. This is the housing sector. You can see big divergence in the housing sector. Not a great sign. The economically sensitive semiconductor index is also diverging, and the semis were diverging back here in December of 24 as well. Now this rally has made a higher high than this peak, but it has not been able to take out this peak, and I've got some concerns with what is happening right now. There is potential for this intermediate cycle to may have topped in the stock market indexes. And this is the financial sector, and some major divergences here when the Dow and the S&P and everything else was making, confirming, higher highs. The banks were diverging, seriously diverging back in, I'm sorry, this is October 23. But they were diverging here back in December of last year. They had not made a higher high, and they still haven't made a higher high. And again, I've got concerns that the sell-off the last 2 days may have completed an intermediate top, which would indicate that it's not, at least during this intermediate cycle, is not going to make a higher high. Now let me go to what is, I would say, it's a possibility. I'm not convinced that this is in play, but it's a possibility. We may be forming one of these megaphone topping patterns, and this is where problems are starting to emerge in the economy, and then the Fed tries to stop it. And we had the same pattern develop back in 2008 as the Fed was trying to print a bunch of money and cut interest rates and stop the housing bubble collapse. This was the tariff scare. And then, of course, the Fed prints a bunch of money and we get this slingshot move back up. But as I said, I'm a bit concerned that we may have completed an intermediate top right here. And the second daily cycle was extremely long, which means this third daily cycle is probably going to be short. And as we've seen many times in the past, the bad stuff tends to happen in September or October. The intermediate cycle is going to be due to bottom probably in early to mid-September. So what I'm concerned about is that we might get, I'm going to say this, if we get follow through lower on Monday, and especially if we break below this support zone right here, then the stocks have completed an intermediate top. And so, but at some point you'll get a bounce. So you'll get an A, B, and then you'll get a C move down. But the odds are heavily in favor that any bounce at that point, and again, let me stress, this is if price continues lower on Monday, and especially if it breaks this support zone right here, then any bounce is very unlikely to make a higher high. It'll roll over as soon as it gets the slightest bit overbought, and then we're open to, if there's some kind of a geopolitical event, we're open to a crash scenario that could come back down and drop below this pivot and continue this pattern. And this is just a volatile pattern of of something is in the process of breaking in the economy, and the Fed is trying to stop it by printing money. So you get the fundamentals start to weigh on the market, and then the Fed prints a bunch of money, and you get this wild volatile slingshot back up. And then at some point, the fundamentals start to weigh on the markets again, and you come down, you make a lower low, and then at some point you get you'll get a rally, but a rally that won't come up and make a higher high. It'll top somewhere here in the middle or lower part of the pattern, and then it will break down. So I'm kind of just keeping an eye on this to see if this might be in play, and actually what makes me think that this is in play is that this move not only dropped below this intermediate cycle low, it also dropped below this intermediate cycle low of 2024, and this was a yearly cycle low. And so the yearly cycle low in 2025 dropped below the yearly cycle low of 2024, and even though stocks, or the S&P anyway, has made a higher high, that's a concerning look. That's a big red flag. In a healthy bull market, you really shouldn't be making yearly cycle lows. Should not be making lower yearly cycle lows from the previous year, and we did this year. So I'm just gonna put this out there. If you've got funds in a 401k, we are very close to all-time highs. Red flags are popping up. Do you really want to keep pressing here with potential that maybe something bad is coming in September and we could shave off another 20, 25, 30% of your off your 401k if we get some kind of geopolitical event that can drive another big crash event to make a lower low. You haven't lost very much, a few percentage points here. Is it worth it to take the chance, or can you just be happy with where you're at right now and then get on the sidelines and wait? Just set and wait until we see what happens in September, maybe October. There's going to be some kind of a move down in September, October, either way, because we're due for an intermediate decline. But if it happens to be a crash event driven by some kind of a geopolitical event and something that goes below there, then you're going to be very happy that you got out, pretty close to the top and you didn't have to take that huge drawdown. And then at that point, you can decide whether or not, this pattern is still in play. Maybe you get in for a couple of months while we get another bounce to the middle. But then at that point, I think there's serious warning signs. We get a Dow theory sell signal that at least, I don't know that this would be a secular bear market, something that's going to last for 9 years like it did from 2000 to 2009, because I think, AI and the drivers of this secular bull are still intact and they're still in the infancy stage. But it could definitely be a cyclical bear market within a secular bear market. And those can be, pretty darn painful. And I would say most people would probably prefer not to weather one of those. So anyway, there it is. In my opinion, some red flags popping up, some warning signs. Decide whether or not you want to maybe get on the sidelines, be happy with your gains, and see what happens in the September-October time frame, and then decide whether or not to get back in.